Hi everyone, hope I'm audible and my screen is visible. So we are going to discuss route finding algorithms and how to find implied volatility from market codes of options, right? So we have we regularly see a lot of talks about implied volatility to 30%, 40%, right? All these terms, but what exactly implied volatility is and how do we find it from the market codes? So that would be the agendas of today's lecture. Before that, let us just discuss briefly what call options are, Black-Scholes formula, and everything. Okay. In case you do not have a background and you find anything confusing, please feel free to ask your doubts. Okay. I'm open to all the doubts. So let us just start discussing, and let's start with something called call options, right? So what exactly options are? First of all, what are options? Options are a kind of derivative again. And what are derivatives? Whose value? Derivatives are something which derives its value from something else, right? So whose value depends upon an underlying, right? Can someone mute the mic? Whose value is derived from an underlying, right? Just a minute. Derived from an underlying, right? For example, uh, so first of all, you have already seen stocks, like for example, let us say Microsoft stocks. So you know how stocks behave, right? When it is, for example, you feel that the price of the stocks may go up, then you buy the stock, right? And when you feel that it may go down, you sell the stock. Now, there exist options on Microsoft as well, right? So now, what are options on Microsoft? Options on Microsoft are something whose value will change as and when the Microsoft value will change. Now, how will the option value will change, right? So let's talk about these options. So what are the, so let's talk about call options first, okay? So call option is an agreement between a buyer and a seller, right? Now, what does this agreement tells? Okay, this agreement gives the buyer the right to buy the underlying at a given price, given fixed price, by the way. If it is vanilla option, if given fixed price at a given fixed date. Okay. So what does this mean? Let's talk about it. The buyer, the right, but not an obligation. This is quite an important step that I missed out. Right. Now let's talk about it briefly and slowly we'll build the momentums for today's project, right? So uh, what does it mean? Okay. So let's talk about the simplest option, which is European call option. Okay. So now what it gives you, for example, you are the holder of a European call option. So it gives you the right, but not an obligation to buy the underlying at a given fixed price at a given fixed date. Okay. So now this given fixed price is called strike price and this fixed date is called expiration date, right? Or the expiry date. So let's take an example, okay? So let us say there is an option, call option, European call option again, on MSFT, which is Microsoft. So on the underlying is Microsoft. K we call the strike price, which we'll be calling 100. And then the time to expiration, let us say this is 1 week from now, just for an example, right? Now, what does this agreement say? If you are the holder of this particular call option, the agreement says that on, so after 1 week from now, on that day, if you want, if you are the holder, if you want to buy the underlying, right? If you want to buy the Microsoft underlying, you can buy at 100 units, whether it is dollar, whether it is rupees, whatever it is. So let's just not, we are just taking an example. So you can take it at $100 or 100 units from the seller, from the guy who has done the agreement with you. As simple as that. Now, I will ask you a simple question. So this is for someone probably who is not aware about what options are. So when will you buy at 100 from that particular person? What should be the market price of that particular Microsoft stock? What should be the market price so that you won't buy from the market, you will buy from the person itself? Can someone tell?
Above
When
100.
it is more than the strike price.
Right. So as someone said, when the price in the market is above 100, right, then you will be exercising this call option, and then you will be buying this Microsoft stock from that person itself. Right? So you will be exercising this call, this particular activity when you buy the stock from that person. This is called exercising the call option. But if the market price is lesser than 100, you want to exercise this option. You will let this option expire as it is, right? And basically, you will go and buy from the market if you want to. Okay. So now the thing is that let us say this agreement is happening today. Okay, let us say this agreement is happening today. So if this agreement is happening today, now let's talk about the seller, this guy who has sold this call option. He has nothing to gain in the future, right? So in the future, if you exercise this call option, you will be gaining some profit from the market. If you don't exercise, that guy has nothing to gain on that day. So today what you will be doing is that you will be paying some premium to that person for this agreement, because in future you are expecting some payoff out of it, right? So what you will be doing is that you will be paying some premium to that person. So this premium, right, or this price is called premium of the call option, premium of the option. It is denoted by sometimes C for call option, P for put option, or sometimes in general V, right, value of the option right now. So this is the premium you will be paying to that person to enter into this particular agreement, right? So this is all about call option, right? And yeah, so if I tell about the payoff after 1 week from now, what will be the payoff? The payoff will be maximum of s minus k comma 0. Where does this maximum of s minus k comma 0 comes from? So when you don't exercise this option, your payoff will be 0. That's it. And when you exercise this option, so this S is ST. What will be the price of the Microsoft on that day, right? So if you exercise that particular call option, then you will be buying at K. And now what you can do is that you can sell it at the market at a higher price. The price in the market, let's suppose, is ST, right? So then you will be the profit that you will be generating on that day, or your payoff is just ST minus K. So your payoff will be maximum of ST minus K comma 0, whatever it is, right? If ST minus K is negative, that means the market price is lesser, so you won't be exercising this option, and your payoff in that case will be 0, right? So I will be sharing some resource for you to read more on what call options are, put options are. I just assume that you have a background in it. I just wanted to help you understand all these, help you just revise all these things. Okay, so now let's talk about Black-Scholes formula. What Black-Scholes formula is. From here things get a bit technical. Please feel free to ask any question if you have. Let's discuss Black-Scholes formula. Okay. So now what this Black-Scholes formula is, right? Okay. So you might have seen this particular formula everywhere. C, that is the price of a call option at time t, right, is st, right, into uh, n of d1 minus k e to the power minus r capital T minus small t. Capital T is the uh, or expiry date of this particular option, right? ND2. Now, what is this ND1 and ND2 is? Now, for the sake of simplicity, what you will be doing is that let us assume small t is 0. That means you are finding the value of the option right now. Okay. Aman, could you please mute yourself? Yeah, sure. Thank you. So, if you calculate the option price right now, it would be S naught ND1 minus k to the power minus RT ND2, right? Now, I will be explaining what these terms ND1 and ND2 are. But S naught is the current price of the underlying, right? Whatever is the underlying. For example, if it is Microsoft, what is the current price of the Microsoft in the market? Okay, and K is again the strike price. S naught is the current price of the underlying, right? K is strike price of the option, and capital T is the maturity date of the option, right? Or the expiry date of the option, or the option expiry date, right? So it's better to call it the expiry date rather than the word maturity. Okay. So what does this formula do? Given the option parameters, which are the strike price and time to maturity, the value of the underlying, and few other terms which are inherently in ND1 and ND2, this particular formula gives you the fair price of the call or put option from in the market, right? Okay. So now the thing is that obviously this is certain under certain assumptions, right? And this assumption doesn't hold true. So if you want to go into the background of this particular Black-Scholes formula, if you already do not have a background, let us just spend a few minutes. I think we have sufficient time to discuss the background of the Black-Scholes formula. Okay, so this particular formula comes from the assumption that your stock price, change in your stock price, so DS is the change in stock price. Okay, so it may be follows geometric Brownian motion. Okay, geometric Brownian motion. Now what this geometric Brownian motion is? Okay, so this is again quite simple if you just look at it. Okay, so this geometric Brownian motion is nothing but mu s dt plus sigma s dw. Okay, now this term mu s dt, okay, is the deterministic term here. Deterministic term is some terms that you can probably predict right now, and this term is the random term. Now let's just speak qualitatively of this particular equation. Okay, so speaking qualitatively, this term, this geometric Brownian motion, or this particular formulation says that, please listen carefully, this says that these changes in the stock price in the market are particularly driven by two terms. One term is the deterministic term, and the second term is the random term. Let's talk about the deterministic term first. It is basically the fundamental nature of any particular stock. Okay, so for example, I live in India, and few stocks in India are considered fundamentally very strong. For example, Reliance, for example, earlier Tata stocks used to be considered, courtesy of Mr. Ratan Tata, the Tata stock used to consider, evergreenest kind of stock, right? And all the stocks. So these stocks had fundamentally nature of, increasing in the long term, right? So this is the fundamental nature of the stock, that it will either grow up or it will either go down, right? And the second term that you see over there is the random term. So obviously, if you consider that the Tata stock is evergreen long-term stock, then obviously it won't go and increase every day, right? Otherwise, does it happen in the market? No, it will decrease on some day, again decrease on some day, increase on the other day. So these random fluctuations, where do they come from? They come from news in the market. They come from the people's expectation. They come from a speculation in the market, right? So this geometric Brownian motion says that the changes in the stock price, any particular stock price, is driven by two terms. One is deterministic term, which is obviously predictable, which is kind of companies, you can say companies' financials and everything, companies' ethics and everything, right? And the random term is just fluctuation by the news. For example, uh, Tata stock, right? So recently a very fatal hair crash happened, right? And so these are certain news that happens, and obviously I should not relate it with this particular kind of stuff. But obviously, for example, currently Indian government has come up with the gaming. They banned the gaming apps, right? So now you see that the last day, all the app stock went down, though they were on the upper trend because of the growth they were seeing in the market, right? Gaming market. So you can relate that the stock prices are fundamentally driven, uh, obviously, and the other thing is that they're news driven. So speculation driven, news driven, whatever you say. So that's something that makes this equation qualitatively. Now, speaking of quantitatively, this mu is nothing but the rate of return of this particular stock. S is obviously the current stock price. The sigma term over here is again the volatility of that particular stock, how much volatility, and S is again the stock price. What is DW over here? Anyone who can set a light of what DW is? Anyone who knows what this DW is?
Is it this stochastic process?
Right. So this DW, obviously this is stochastic process. This DW is called a standard Brownian motion. Standard Brownian motion. Now, what this standard Brownian motion is? Again, this is obviously a thing for to discuss in the separate lecture, right? So standard Brownian motion is a set of random processes which follow a certain rules, right? So you can assume, but for now, what you can think of this DW is that it is just so. For example, let us say there are terms like x1, x2, x3, x4, and then they follow certain rules. Some of these rules are x2 minus x1 is normally distributed, right? All these increments are normally distributed with a mean of 0 and a variance of t2 minus t1, right? If you know t2 and t2 and t1. And obviously this would be stationary. So obviously I can share you some resource to discuss regarding it, because this is not the core agendas of today's lecture. But again, the main thing for me to bring up this equation was that this is the equation from which we have the Black-Scholes derived this particular formula for the call option price. Okay. Now, one thing that is very important for you, because most of the time you will be seeing, okay, market does not follow Black-Scholes. So what does it mean? Basically, if you see this particular equation, okay, this particular equation tells you that the return of the return of a particular stock follows normal distribution. Okay, the return of a particular stock. So if you find the returns on each day, right? So what will the return on each day? It will just be S2 minus S1. So it follows normal distribution. And from that basic assumption, you have basically derived this particular formula. Okay, right? To derive this particular formula, you will need a lot of stochastic calculus. But those who are into quant trading and all, they don't go into much detail, right? And particularly for the agenda that we have for the today's project, we don't need all this information. uh, but again, I'm just introducing it to you, because you can go back, surf the internet, and learn about all these stuffs. If you have any doubt, feel free to reach me out. Okay, so one of the basic assumption of this particular model was that the returns are normally distributed, but it does not happen. The returns are not normally distributed. And so you will observe that if you take any option price on any exchange, and if you fit into this formula, the price will not match exactly, though it will be obviously near close whatever you say, but they won't match, right? That's the reason. Okay, so now let's talk about this particular formula in detail. Any questions so far, by the way?
Is it as of now, I would just take it as like it's just to find the fair value of the option in the market, right? Like the future value of the option.
Not future value. It is to find out the current value of an option. What is the current value that, so for example, if I were to say, okay, Akarshit, this is a call option, this is having a strike price K, this is having time to maturity capital T. So at what price will you, and the underlying is this. So at what price will you be interested to buy this option from me? Okay. So what you will be doing is that, Kshitij, market price of this option is this, and so I would be buying at this price only. Okay. Otherwise, it will lead to arbitrage on both side. Okay. So for example, if the market price of that particular option is 100, you won't agreeing on buying this option at a price of 105, right? This does not
Yes.
make sense. And similarly, I won't sell you at 95, obviously. So we both will be agreeing at 100, including some transaction cost and all, leaving everything aside. Now, if you calculate the price of the same option using the black sols, which gives you the current price of that particular option, that would be very much different from 100. That won't be 100. Now, why is it not 100? Again, the reason is that it does not. So the assumption that was used to derive this particular option does not hold true in the market, right? Uh, we can have a lot of discussion regarding it, or maybe in a separate lecture, but that is basically the core agenda, right? Or if you want certain hints on the direction to search, you will find that the basic assumption of the Black Scholes model was that the returns are normally distributed, right? Sorry, if it is not a perfect diagram, but obviously you can, I think, adjust with it. So this is the core assumption of the Black Scholes model. But in general, what happens is that the return distribution that you see in the market are will be having skewness and will be having kurtosis too, and that leads to an option having more or lesser price than their market than their Black Scholes price basically. So that is the reason. The core reason why you don't see the price matching with the Black Scholes price is the uh, that returns are not normally distributed. Okay, so I hope it makes sense. Sure. Okay, so now let's get back to the Black Scholes equation. Okay, the Black Scholes formula. So this formula gives you what should be the correct price of the call option, any option, right? Or what should be the price right now. Now let's discuss what ND1 and ND2 is. Before we discuss what are these ND1 and ND2, let us just write the formula for D1 and D2. So D1 over here is again ln of S naught by K, okay, plus R plus half sigma square. R is the risk-free rate of return in the market, right? What is the risk-free rate of interest, right? Or other terms. So what is the risk-free rate of return that you will be getting in the market? If you invest something in a risk-free asset, what is the return that you will be getting? So this is the formula for D1. Okay. Sigma is again the same term that appears in the uh, Black Scholes formula. Okay. Sorry, the GBM, geometric Brownian motion. Okay. And D2 is D1 minus sigma root T. Okay. By the way, there is a very famous quant interview question. Why don't this term mu, which is the expected return of this particular stock, does not appear in the Black Scholes formula, right? Or in the other way around, why don't this term mu affect the option price, right? This is a very good question, and I hope you can surf the internet and let me know the answer. Why don't expected return or why don't mu affect the price of the option? Please, research on it and do tell me your answer. What do you think about it? Okay, so D1 and D2. Now let's talk about ND1 and ND2. Okay, so D1 and D2 are just certain terms. Okay, and then ND1 is just cumulative normal distribution of D1. Okay, so what is CDF? Cumulative distribution function of D1. ND1 is nothing but CDF of D1. Right, so I would be explaining it quite easily. So let us suppose you're finding n of 0 minus 0.6, right? If it is 0, if it is 1, and if it is minus 1, so this minus 0.6 means if there will be a certain points minus 0.6 over here, then this is the area that you are considering. So this area is called ND1, n of minus 0.6. This is the cumulative distribution function. So what is the probability that uh, so this, if you want to define minus 0.6, so it is like n, what is the probability or probability that you will observe number lesser than or equal to minus 0.6, right? So this is the normal distribution concept. So that's why you see that this quant form has a lot from probability and statistics, right? And that's the reason. I hope it becomes clear if you are a newbie into quant finance, right? So again, in Python, a direct formula exists to find out ND1. It is just norm.cdf of D1. So if I give you certain parameters, right? So what are the parameters on which this call option price depends, right? So the parameters are S, which is the current stock price, K, which is the strike price of that option, R, which is the rate risk-free rate of return in the market, capital T, which is the expiry date, and sigma, which is nothing but volatility of this. Now, uh, if I give you all these terms, right, you can easily calculate the price of the call option. That is easy, right? If I give you all these parameters, you can just substitute in this and find D1 and find D2, find ND1, find ND2, and then just use this particular formula, and then you will be getting the call option price. Is everything clear till now?
Yeah.
Any doubt, anyone? If you have any doubt, feel free to ask. Let us just take it as for the first stop in case you want to discuss anything.
Yeah, could you please explain what's like D1 and D2 again?
D1 and D2 are just certain terms, right? So D1 is just, so it's kind of, you can understand it's a formula. So D1 is ln of S naught by K plus R plus 1 by R plus half sigma square into T. So like using all these terms S, K, R, sigma and capital T, you are finding D1 and D2. So these are just formula. And then we
But,
use it to find ND1 and ND2.
uh, but what's the terminology
So we don't
like
have
for?
any particular term for D1 and D2, but ND1 and ND2 denote certain terms. So I will be explaining it just some now. So they are some like probability of option to expire in the money and then the delta. But again, that is to talk of the future. But as of now, they don't. We don't call them something. So D1 and D2 are just D1 and D2. They don't have any term or they don't have any meaning as such. ND1 and ND2 have meaning. I will explain what these terms mean.
Okay, thank you.
Okay. Anyone else have any question? No. Okay. So I think everyone is quite clear till now. Okay. So given all these terms, you will be able to find out the formula price of the call option. But the real challenge starts now. S naught is the underlying price. Uh, why don't someone ask why don't mu? So why does not I should write. So this is why doesn't mu affect the price of the call option? What is this mu? Mu affect the price of this call option. So what is this mu, by the way? This mu is the rate of return of the stock, or you can say expected rate of return on the stock. So for example, this option is, let us say Microsoft. So you will have certain expectation from the Microsoft, right? You will have certain expectation from Microsoft. So this mu is called the rate of return, expected rate of return from the Microsoft stock. Okay. So for example, if you are expecting 6% rate of return from Microsoft or 7%, so that is mu. Or sometimes they are also figured out historically. So historically, if you have got a return of 10%, then you just expect that in future you will be getting the same return. But again, this term does not affect the price of the option on the Microsoft. Why? That is the question. Okay. So again, getting back to this particular part, right? So I was saying that okay, S naught is something which is the underlying price, that is the price of the Microsoft stock. Again, that is quite clear. I can give you the Microsoft price. K is the strike price of the option, that is the property of the option. So you will easily have the value K. R is the risk-free rate of return that is in the market. You can easily get the value of R from the market. Capital T is nothing but the expiry of the option, and that is basically that is something that basically defines the option. So you will have capital T. But let's talk about sigma, right, which is the volatility. This sigma is the culprit over here. And why? Let's talk about it. So this term mu and sigma, when you so mu does not you know affect the price of the option, so let's not talk about mu. But what is this sigma? So when you enter into this formula GBM, geometric Brownian motion, essentially what you mean to use is what is the current volatility, what is the current volatility, what is the current volatility, right? Sigma, what is the current sigma, and then you will be putting it into the GBM, or you will be putting into the call option price. But the challenge is difficult. How do you measure volatility, right? do you say like, okay, volatility right now this second is 100, this second is 60%, this second is 30%? You won't calculate volatility like that. You can't, right? Because volatility is something that you calculate. For example, if I say you historical volatility, okay, you can tell what is historical volatility in a month, right? A standard deviation in a month, right? So you can tell that term. But what is the current volatility? This is something that you can't measure, right? So this is where the problem starts, because you can't supply sigma to the black holes, right? What people in the market have started doing is they inverted the problem. You already have the market price of that option, right? Any option, you have the market price from the exchange, right? So you will have the market price of that option, right? So what you do is S naught, K, R, T, and sigma. So what value of sigma will give me this particular market price of that particular option, right? What value of sigma will give me the particular price of this option, right? So let us say the Microsoft stock, that option that we are constantly talking about. Let us say the Microsoft stock price is 10. So what value of sigma should we put into this Black-Scholes formula so that the price comes out to be 10, right? This particular value of sigma is called implied sigma or sigma implied volatility, right? This value, the value of sigma, which when put into the Black-Scholes model or Black-Scholes equation, gives you the market price of that particular option, is called implied volatility. Everyone got it? Any
Yes, sir.
question? Everyone got it right? No need to call me sir. You can call me Kshitij. So everyone got it right? So this particular value of sigma is called implied volatility.
चला गया था आ जाए लगा
Please mute yourself. Right? So this particular value of sigma is called the implied volatility. So now you have heard the word implied volatility a lot. Now you at least understand what's the meaning of implied volatility, right? So in a way, this volatility that you will be getting from this particular equation, right, is called implied volatility, and this is like your expectation of the future volatility of that particular stock, right? So this is like, if let us say there are, you say you got sigma equal to 30%, then this is your expectation that in this lifetime of the option, right, whatever is the time remaining in this option to expire, right, we will be expecting a volatility of sigma implied percent, right? Got it everyone? Any question?
No, sir, understood.
Okay, so what we have to do now is, let's try to find out sigma. Okay, so what is our task? We know that the formula is S naught nd1 minus k to the power minus rt nd2, right? Things quite simple. And so this is the price of the call option, right? And now I want to find the value of sigma such that this S naught nd1 minus k to the power minus rt nd2 will be equal to the market price of the call option. So you can get the price of the call option from the market. You already know all other parameters. You have to find out this sigma. This sigma is called nothing but, this sigma is called nothing but
Implied volatility.
implied volatility, right? So let us, since this is something now, this is you can say Black-Scholes formula C. So this you can say CBS, and this will only be a function of sigma, right? You can put all other parameters, right? So there will be numbers only, they won't be variable, because you know, right, all these terms are variable itself, so they won't be a number now. Only sigma will be the variable, because you don't know the value of sigma. Minus C market equal to 0. So you have to solve this particular, so you have to find the root of this particular equation. So for what value of sigma this will be 0, right? For what value of sigma this will be 0, and that value of sigma will be implied volatility, right? So this is the value of sigma. So we have to find the value of this particular sigma. But again, you know that you won't have be having a closed form solution, right? You won't be having a closed form solution. So that's why we have to use certain approximation, right? So is everything clear till now, so that we can dive into the mathematics of how to find the root using the root solving algorithm?
I have a question. So
Yes,
like
Akarshit,
the
sure.
volatility at that particular time, that was a like primary goal at that moment. Like, but since we didn't have the volatility, we used the current market price, and for that we got the implied volatility. But
Right,
as if you think that the volatility we are getting is for the less time frame till the expiry date. So how
right.
usually we like since we wanted the volatility at that particular time, but instead of that we are getting the X percentage for the less time frame. So
Right. So that's a good question, by the way, Akarshit. So let's
yeah,
discuss a bit about it. So the question he says, I'm repeating it for everyone, right? So we say that since we don't know what is a sigma right now, so we inverted the problem and we put the current market prices of the call option, and then we got sigma, and then we are saying this is a market expectation of the volatility in the coming time from today to the expiry date. So think about, let us think a bit about it. By the way, this is a very good question. So what is the answer? The answer is that sigma obviously is the current volatility. But since you are finding it from the market price of the call option, and where do you get this market price of the call option, or what does this price of call option signify? This particular call option price signify the expectation of the stock, or expect how from where will the stock go from today to the end to the expiry date, right? This particular C value, this particular C value signifies where can the stock goes, or where can the stock go from today to the expiry date, right? This whole path, right, will basically determine what will be the price of that call option, right? That's why this particular sigma that you find from here is like what is the expectation of the volatility from today to the end. Obviously, this is the current expectation. If you put in the price of the call option at a different time, then this sigma will change accordingly. So just because you are calculating it from the current market price, this is telling you the current expectation of what will be the volatility from today to the end date. Is that clear now?
yeah, got it.
Okay, thank you. Fine. So now, what I mean to say is that uh, we have to find what is the root of this algorithm, right? Now you might say, okay, why do we need to find out sigma? That is a very good question, by the way. Why do we need to find sigma? So let us make the lecture interesting and let us take it further. Uh, Later part of the lecture today. Okay, at the end we will be discussing why do we need to find sigma, and most of the time we will be seeing all the option traders, they basically quote in the terms of option volatility only. They don't quote in the terms of prices, $100, 20. They don't say it. They say 30% IV, 40% IV, 35% IV, like that. So whenever you see traders option traders, you will notice they quote in the terms of IV basically. Okay, so far so good. So that's why I will be explaining you why do we quote in terms of IV in the later part of the lecture today. But for now, let's start discussing root finding algorithms, few root finding algorithms. Okay. So first of all, let's talk about one of the very famous root finding algorithm, which is Newton-Raphson's algorithm. Okay. Okay. So Newton's-Raphson's algorithm is used to find out the root of a particular equation in case you don't have a direct, or you don't have a closed form root. Okay. So obviously, I will be taking a sample example today, but let us first discuss what is the theory behind the Newton's root Raphson's algorithm. Okay, so let us say we have an equation like this, which have a graph like this. This is your x-axis, this is your y-axis. Let this function be f of x. Okay, right? And uh, so what you do in the Newton's Raphson's algorithm is that you start with an initial guess x naught. Okay, and you say, so what is obviously the root of this particular equation? This is the root, right? So your goal is to reach over here. But obviously you can't draw everything, so you will start from somewhere. Let us say here. You will be saying that okay, x naught is the root. And so at x naught, what is the value of this function? This will be f of x naught, right? And if you draw a slope at this point, so this will be somewhere like there, and let this point be x1. Okay, so you see x1 is closer to the root than x naught, right? Okay, so let us try to find out a way to reach to x1, and then we'll update it accordingly. So first of all, our guess will be x naught. We'll be saying that x naught is the root of this particular equation, right? And now if you see this particular triangle, right, this particular triangle that has been formed, so this particular theta, so what will be the value of tan theta? Tan theta is the slope of this particular equation, so you can say this is f of x naught, right? Tan theta will be nothing but f of x naught, the slope of the equation, the slope of this particular equation. And as you know, the slope of this particular equation will be f dash of x naught, because this is the uh, tangent to this line at this point. So this will be f of x naught. And this will also be equal to, if you see this particular triangle, this will be equal to this value divided by this value. So this will be f of x naught, the y-axis is f of x naught, and the lower value will be x naught minus x1, right? So this will be x naught minus x1 is equal to f of x naught divided by f of x naught, right? And so x1 will be x naught minus f of x naught divided by f is x naught, right? And then you see that you have reached closer to x1. Again, what you will be doing is that you will be updating x1 again. So now your again next root will be x1 minus f of x1 divided by f dash of x1. Similarly, x3 is equal to x2 minus f of x2 and then f dash of x2. So eventually you will reach closer to your goal. What will be your end goal? Your end goal will be to ensure that you reach some at a place where f of xn is closer to 0. At a point, if you find that f of xn is sufficiently equal to 0 or closer to 0, then at point you will be saying that, okay, this is the root of this particular equation. Is that point clear, everyone?
Yes.
Everyone?
Yes.
Any question? Any doubt? So how to find the root of an equation? You will be starting with a guess, and then you will be saying what is the value of the f at that particular point. You see that okay, this is not closer to 0, right? Then you will be updating that particular guess using this particular relation, right? And then you again check what is the value of f at that particular point, and then you update it continuously until you reach at a point where the convergence where you have reached a convergence, right? Uh, okay, does that answer everything? Okay, so let us take a simple example. Okay, so let's take x square plus 5x plus 3. Uh, so what I was doing is that because we had a class of 2 hours only, and we had a lot to cover. So at the end, I was just using calculator to take this example and using calculator to show it to everyone in the lecture. But apparently, after I did all the calculation, I got that this particular equation is two roots, right? So obviously, you will have to do for both the roots, right? But again, uh, for our use case in the Black-Scholes formula, we will have only one root because the curve is like this, right? Has an inflection point as well. So there we don't have to worry about it. But this particular equation is two roots. But I will just show you how to use Newton reference algorithm, and we'll be finding one of the root. Okay, just for the example sake. Okay, so this is x square plus 5x plus 3. What I will be doing is that let us start with a guess, and let us just say we have x naught is equal to minus 2. Why I took minus 2 is if you find out what is f of x naught at minus 2, what is this value f of x naught at minus 2? So we are trying to find out the root of this particular equation. Okay, what is f of x naught at minus 2? And f dash x will be 2x plus 5.
-3.
-3, correct? Okay, so f of x naught will be -3, and so let us update this particular. So because this is -3 and this is obviously not closer to 0, so we will be updating this particular case, and then it will be x1 is equal to x naught, which is -2, minus f of x naught, which is -3, divided by f dash of x naught, right? What is f dash of x naught? F dash of x is 2x plus 5. F dash of x naught, yani ki f dash of uh, -2 is 1 over here, right? What is this value? This is -2 plus 3. This is 1. Okay. So this is 1. Again, you will be evaluating what is f of 1. If you check f of 1, it will be 9, right? Or sorry. Yeah, it is 9, right? Am I right? Yeah, it is 9. And then you will be calculating x2. What will be x2? X2 will be x1. X1 is 1 minus f of 1. What is f of 1? It is 9 divided by uh, what is f of here we write f dash of x1, right? So what is x1? X1 is 1.
7.
So what is this value?
7.
7. Correct. So it will be 7. Just a minute. And then this value will be 1 minus 9 by 7. Let me just calculate it, because apparently I wrote 10 instead of 9 in my notebook. So it will be 1.28, and then sorry, yeah, it would be 1.28, and then finally what we will have is minus 0.28, right? And then you will be calculating what is f dash of x naught, what is f dash of minus 0.28, and then you will be seeing whether it basically is closer to 0 or not, and so on, right? So do I need to show it further? Because I think it's quite simple. Anyone who do not understand this or who has any doubt in this? So the rule of updating is x of n is x of n minus 1 minus f of x n minus 1 divided by f of dash x of n minus 1. Got it?
Yes, yes.
Right. Okay. So, okay. So let's, I will discuss one more method of the root finding algorithm, right? Because I would expect that you implement that algorithm as well. But before that, let us see how we will be using this in to find out the root of the particular equation that we are interested in. So we are interested to find out the root of SCBS of sigma minus C of market equal to 0, right? C of market would be just a number. C of BS sigma will be kind of an expression where everything is number, but there will be a sigma term over here, either in the denominator or like combination of numerator and denominator, right? And we have to find out for what value of sigma this term is 0, right? So let us say this is our f of sigma, right? And we have to find the root of f of sigma. This is quite simple. Okay, so we'll be starting with an initial case, right? There will be a sigma initial, right? And what will be the rule of updating? Like just like the Newton-Raphson's method, what you will be doing is that you will be updating sigma n plus 1 will be sigma of n minus f of sigma, right? Or f of sigma n, right? Divided by f dash of sigma n, right? Now let's talk about f dash of sigma n, right? What is f dash of x, right? So at this point, what is f dash of sigma? This will be differentiating both this term with respect to sigma. If you see the second term, which would be just a number, the differentiation of this particular term with respect to sigma will be 0. And the first term, right, which is nothing but this particular thing. Everything is constant, only sigma is a variable, and we have to differentiate it with respect to sigma. You will, I'm just writing the answer because this is your task to find out. Prove that f of dash sigma is will be nothing but s naught into root under t into n of d1. What is this? N bar. This is just CDF. So what we talked about this point, ND1 is PDF. Sorry, ND1 is CDF. This is PDF. Okay. So in Python, you will be using norm dot PDF of D1 to find the value of this particular stuff, right? So now what you will be doing is you will be starting with an initial guess, right? Based on that guess, you will be calculating what is the value of CBS of sigma minus C of market, right? For that particular value of sigma, then you will be calculating what is the value of this particular term for that particular value of sigma, right? And then you will be updating this guess, and then you will be checking whether for this particular value this is 0 or not, right? Does that make sense, everyone? Does that
Yes,
make sense?
yes,
Okay, sure. So this is how you will be doing it. You will be doing it until you reach a point where this term, entire term is very much closer to 0. Okay. So everything is quite simple. I will be explaining what what I expect from you in the project, because project is nothing but just the basic implementation of this stuff. Okay. The other method that I would be interested to discuss is the root finding algorithm. Sorry, bisection method. This is again a very popular method to find out IV from implied volatility. Sorry, from the market prices of the call option or put options. Okay, so this is quite interesting, by the way. Just a simple mathematics. So what they do is, let this point be A, okay, and let this point be B. This is again your f of x. So what you do is that you find out a pair of A and B, okay, such that f of A into f of B is lesser than 0. Now, you guys, some of you, any of you, could you please tell me why do you do that? Why do you find a pair of A and B such that the f of A into f of B will be lesser than 0? Why do you do that? Can someone
Because
look at
one time it is crossing the x-axis, so that there will be one point where it will be zero in that
right,
range.
right, and that will be the root of that particular equation, right? So if
Yes,
I'm
yes.
able to find out, so this is obviously for a continuous function, right? For a continuous function which crosses the x-axis, right? So if you are able to find out a point, 2 points which gives you the opposite value, so f of a into f of b is lesser than 0, then you are very much sure that uh, the root lies somewhere between a and b. Okay, so now what will be your next step? Your next step will be to use a term c equal to a plus b by 2, right? Now, once you find out this term, then what you will be doing? Can someone tell me the strategy? If I am able to find out a term C, then what will I do? So if I look at the midpoint, and then I will be checking whether f of c is equal to 0 or not. Okay. If fc is not 0, then what I will be doing, either I will be going with a comma c, or I will be going with c comma b, right? Which I will be going with again? Which part? The part which is giving me the negative sum, right? So let us say c is here. Let us say this is c. So fb into fc will give me negative value. So I am sure that now the root lies between c and b, right? So I will be going with it. And then I will again go with c plus b by 2. And then I will again check between which two terms the root lies. And then I will continue this iteration. Did everyone understand bisection method? Did everyone understand the bisection method, or do I need to explain it again?
Understood, sir.
Okay. So let me just take one example and then it would be clear. So let's talk about x square plus 5x plus 3, right? So if you check for minus 1, right, f of minus 1, it would be 1 plus 3, 4, minus 5, 2. So it would be minus 2, and for f of 0, it will be 3. So these two terms are obviously, if you multiply these two terms, they are negative. So you know that the root of this particular equation, one of the root lies between -1 and 0, right? So you obviously you will be calculating the midpoint. The midpoint would be -1 plus 0 by 2, which would be minus 0.5. Now, what is the value of f at minus 0.5? It would be minus 0.5 square plus 5 into minus 0.5 plus 3. Let me do this calculation. It would be minus 0.25 minus 2.5
0.75.
plus 3. 0.75, right? And obviously, so I know that the root now lies between -1 and minus 0.5. -1 and minus 0.5. Because uh, here it is negative and here it is positive, right? And then so again I will go at the midpoint of these 2 points, which is -1 minus 0.5 by 2, right, which would be minus 0.75. And then I will be checking which 2 points to go with. If I'm not wrong, then f of minus 0.75 would be negative, right? uh, Minus 0.75. So minus 0.5 is positive, right? So yeah, it has been negative. And so the root would now lie between minus 0.5 and minus 0. Sorry, 75, yes. And then again you will be calculating at the midpoint of this. And so finally you will reach at a point, if you check at the midpoint, if it is closer to 0, then you will be basically you will be satisfied with that answer, and that will be the root of the particular algorithm. So this is something that you can use for that particular Black-Scholes method as well. One of the advantage of bisection method is that you don't derivative is not involved, right? Because sometimes your gradient becomes quite low. In that case, it is a problem. So one of the advantages of bisection method is that derivative is not involved, but it is a bit slow in converging. On the other hand, the Newton-Raphson method is fast in converging, but the derivative is involved. In case it becomes closer to 0, so it becomes problematic. So these are the two methods that you will be using to find out sigma, that is the implied volatility from the Black-Scholes model. Is everything clear till now?
Yes, it is.
Okay. So now what is your project?
I have a question.
Yes, please.
This bisection method is applicable only for monotonous function, no?
Monotonous and continuous, yeah, of course.
Hmm. Okay.
So monotonous, no, sorry. Monotonous is not a necessity, because let us suppose you have a curve like this, right? So even for this curve, this will be applicable, right? You see that if you are able to find out A and B like this, you'll be able to find out, right?
Okay, yes.
Okay. So let's talk about the project. First of all, uh, because if you're a beginner, I think just do one thing, take sample values. If you're a beginner, of course, take sample values. Uh, maybe you can write it like define a function CBS which takes all the input and gives you the Black-Scholes from price, right? And then this function would return the Black-Scholes price. Second thing would be to implement Newton-Raphson algorithm. Implement Newton-Raphson algorithm and the bisection, both these algorithms, right, to find out IV, right? So implement the code for these particular things, and then at last find out a sample value, pass out a sample value, and so that your code is working. You can match your answer, right? So with any website. So on the if you search into Google, you will find a lot of websites wherein you can enter the parameters, and then it would give you sigma IV. Okay, so you can match your answer with that particular website, and then you can submit it. Okay, so that is the task for you. Is everything clear? Implement both these algorithms to find out sigma IV, simple sigma, so implied volatility, sigma implied. Okay. Everything makes sense, right?
Yes, Kshitij.
Okay. So now finally, let's talk about why do we need to find out sigma? Why is why quote options in terms of IV? See, thing is that IV is like of a standard stuff, right? So let's talk like this. So I and you enter into an agreement wherein I say that uh, you know I will be buying this particular option at 30% IV. Okay? I will be buying this option at 30% IV. Now, what is the benefit out of it? If you ask me, the benefit out of is that even if the spot price changes, okay, sorry, even if the spot price changes, right? So when the spot price changes, what happens? That call option price changes, right? Or option price changes. But I'm talking about call price today, so the call option price will change. But this IV remains same. So if I and you discuss something like, okay, I'm buying this call option from you at 100. Now, at the moment the spot in the market changes, because obviously the call option price is a factor of a spot price itself, right? So if the spot price in the market changes, the call option price will change. So I and you will not be able to transact. But if I and you enter into an agreement such like, okay, I will be buying you at 30% IV, right? So at any point of time, whatever is the spot price, I will be putting 30% IV into the Black Source formula, and then I will find out the what is the price from it, right? And then easily we both can transact at that particular price, which will be given by the Black Source model, right? That is 30% IV. Okay. So this is one of the thing. Second thing is that for multiple for same underlying, right, for the underlying on Microsoft, there can be multiple options, right? Options kept having different strike prices, like option having a strike price 100, 110, 120, 130, and different expiries as well, 1 week, 2 week, 3 week, right? So, and obviously all these options will have different prices, right? So it would not be possible for us to track the prices of all these options. That's why we quote in terms of IV. So if we quote the prices in terms of IB, we will be able to compare the prices of all these options. So one option is having a 20% IV, other is having 30%. So I will be saying which option is, cheaper, or which is, costly, and all those things. So that's why quoting in terms of IV is quite helpful for traders. So that's why you see the option trader frequently quote in terms of IV instead of the prices directly. Okay. And that's why you need to find out IV. And that's why you see that if you are from India or any other country, your option exchange provider, uh, apart from providing the price of that particular option, also provides IV. So you can go and check the Nifty option chain as well. You can search it on Google, and then the first website that appears will be the Nifty option chain. And then when you see the data that appears, right, it will be kind of a spreadsheet sort of thing. You will be seeing a IV column too. So that is the reason they quote IV. Other than that, it does not have any special significance. Now, IV has some multiple significance as well, right? From here, you will be seeing that there is implied volatility smile, which we call IV smile, right? Which is the implied volatility of several options of different strike prices, K1, K2, K3, K4. So this will be the an option having strike price K1, an option having strike price. So these all things are talk of the future. If you are interested to further continue, I can obviously continue this project depending upon the interest that you have, right? So for now, let us see how many of you complete this particular project and uh, send the code, right? Any question, feel free to ask. Otherwise, I will be sharing this particular notebook in the group, and I'm open for any doubt while you code all these stuffs. Okay, so feel free to tag me in the group. Thank you. By the way, if you're watching the recording and if you complete this project, please do tag me if you share this on X or LinkedIn, whatever it is. I would be happy to, look at your work, and it would make me happy that my initiative is helping you. Thank you.